Hi, everyone. Good afternoon, and welcome to our Group 6 presentation today. We will be covering Chapter 10, Introduction to Inventory Management. Brief overview of Chapter 10 is going to include Section 1 to 4 with the conclusion. We're going to be talking about inventory management with me, Jasmine, how to measure inventory, days of supply in turns with Kimmy, evaluating inventory turns and days of supply from financial reports with Inez, inventory, stock out, and holding costs with Justin, and then we're going to wrap it up with the conclusion with Eric. So in Section 1, inventory management, we're just going to kind of talk about types of inventory, inventory management capabilities, and reasons for holding inventory. I'll start this section off with a quick little video for you guys.
Inventory is the accounting of items, component parts, and raw materials a company uses in production or sells. Inventory is one of the most important sources of revenue for a company. Inventory turnover represents sales and is classified as an asset on the balance sheet. On the other hand, too much inventory can become a practical liability. There are three common types of inventory. Raw materials, the materials used to produce finished goods. Work in progress, raw materials in the process of being assembled into finished goods. Finished goods, goods ready to be sold. There are also many specialized types of inventory, such as MRO, transit inventory, and service inventory. The first best practice around inventory is tracking. When businesses effectively manage inventory, they keep just enough stock to fulfill customer orders, freeing up cash for other business needs and future investments.
So previously we kind of touched bases on introduction to processes in chapter 2. And in this chapter, we learned about a really broad interpretation of the definition of inventory. An example of that would be that customers waiting in line at a grocery store, for example, were those slow units. They were that inventory piece in that process. But in this chapter, we're just going to narrow it, kind of take a little bit more traditional approach of the term inventory. And we're still going to think about inventory as flow units within a process, but we're going to think more about the inventory being those physical units within the process. And an example of that would be like cars at a Hyundai dealership, sunglasses at a Sunglass Hut, and even some pizza boxes at a Domino's, okay? Ultimately, the goal of inventory management is going to be maximizing profit, having the right product at the right time, and fulfilling our customers' needs. This could greatly impact the success of a firm's profitability if they are more successful or if they ultimately fail at inventory management. I'll go ahead and give you guys a few seconds to go over this vocabulary. So we talk a little bit more about inventory, inventory management, raw materials inventory, work in process inventory, and finished goods inventory. Okay, so the types of inventory is typically divided into 3 different categories. So we have that raw materials inventory, work in process inventory, and finished goods inventory. This could kind of be thought about the before, during, and after process inventory, depending on the kind of the perspective the firm is into. A good example of that perspective would be maybe you have a steel manufacturer, their end product, that finished goods inventory is going to be the steel. But if you're, you make cars, for example, that steel is actually going to be the raw materials inventory, where you're going to have to convert that input of a raw material through that process to become that output for your inventory. The manufacturing firms typically have all 3 types of inventory, but when you're a little bit lower in that supply chain, like a wholesaler, a distributor, and a retailer, they will typically only carry finished goods inventory. We also have an RFID tag, which is going to be a radio frequency identification. This is just a small electronic device that transmits a unique radio signal to identify the object to which it is attached. We'll kind of touch on this again in the next section. So For any type of inventory, a firm requires a diverse set of capabilities to be able to manage its inventory effectively. They use things like forecasting, product and demand tracking, analytical skills, and product transportation and handling assets. So, this forecasting piece involves predicting future demand. This is incredibly challenging, but it's critical and essential for inventory management. And it's how firms are able to provide immediate service to customers. Product and demand tracking data is necessary so it could produce accurate forecasts to be able to know like when and where this product needs to be and how much. This inventory data is actually pretty difficult to maintain. There's just a lot of various factors that go into identifying these sources of waste, and lean operations in the previous chapters we learned about just really aids in identifying what sources this waste is coming from so that they could be ultimately eliminated. And with the RFID tag, this is kind of where it really comes into place. The tags are going to be used to transmit a unique signal to identify objects, and it's going to be able to be more effective than like a barcode or individually trying to scan each item, just because things could get lost, misplaced. You'll have internal and external theft. So it's just a little bit more of a cleaner way to be able to identify product. We also have some analytical skills. They're valuable to utilize for inventory data. It kind of just helps us make good decisions regarding inventory quantities and placements again. Firms could either make their own software, kind of figure out their own solutions and develop their own in-house talent, or a lot of other firms could also purchase the inventory management software from outside vendors and kind of just tweak it to be able to suit the firm's particular business needs. And we have some product transportation and handling of assets. So this is kind of the last step to inventory management that requires the inventory being physically moved quickly, safely, and the most cost-effectively way as possible. So assets include anything from large automated sorting equipment to robotic forklifts, fleet of dedicated trucks to be able to move all this product, as well as having skilled employees. They're going to be able to ensure that the product is not damaged and that the data is being recorded accurately. Here's some more terminology for this next upcoming part of my section. So I'm going to go ahead and let you guys pause it and take some more notes on these different terms. Okay, so now we're going to cover reasons for holding inventory. So you just need to be able to talk about why you're holding the inventory and make it make sense for your firm, right? So being able to articulate why we hold on to inventory, and depending on the situation, we can explain it, whether it's relevant to flow time, seasonality, batching, buffers, uncertain demand, and pricing. This flow time occurs because of the time it takes for flow units to be transformed from inputs to outputs, and then from outputs to get to where they need to be. This is also something we've learned previously, and we could calculate using Little's law, because there's always inventory within that process that's going to be able to use that formula. Seasonality is going to be a predictive variation in demand. So most items have that type of predictability depending on like that seasonality. So seasonality could be anything from, nature seasons to holidays, annual events, or even some smaller timescale reoccurring events. An example of that could be like in summertime, you're going to see an increase in plastic pools and swimwear, things like that leading up to summer. And during summer, we have like pumpkins. That's going to increase in demand in October and fall. And then pencil and paper experience that increase in demand just before school starts. Getting everybody ready, you're going to have to be able to increase that inventory and prepare for just having that more product available for your customers when it's going to anticipate that demand. Production smoothing strategy. It's going to be able to manage a firm's seasonality inventory in situations where that capacity is usually less than what is needed to handle peak demand, but also be able to handle too much during that time of slow demand as well. Inventory batches, they're going to be able to represent a number of inventory items that are received on a specific date for specific costs. So when a machine is producing a batch, it usually produces at a rate that exceeds the flow rate of the item through the process. And then this inventory between process setups can serve as buffers. So this just means that the process steps can operate independently from each other. A buffer is able to absorb variations in flow rates by acting as a source of supply for a downstream process step, even if this process operation itself might not be able to create this supply at the given moment in time. A buffer acts as a cushion to absorb the impact of potential harm. We also have uncertain demand. This is just unpredictability. So firms usually choose to carry more inventory than needed to satisfy the predictable and unpredictable demands of their customers. That extra amounts of inventory on hand is needed to buffer against demand uncertainty. And this extra inventory is referred to as safety inventory or safety stock. And finally, the last reason for holding inventory is going to just be price. So firms hold on to inventory because they're responding to changes in the cost of value of inventory. This price fluctuation is a major factor for holding inventory. And sometimes price may be the most important factor over all of these previously mentioned reasons for holding on to inventory. Alrighty, now I'm going to send you guys over to Kimmy. Thanks, guys.
Hi everyone, my name is Kimmy Sano. I'm a third-year marketing major here at Cal Poly Pomona, and I'm going to be discussing today section 10.2. Just before I go into more details of the chapter, I wanted to just bring up the key terms that I will be discussing today. And the two main points that I'm going to be touching on are the days of supply and inventory turns. I'm going to provide some definitions, some examples, and some reasonings to why one would want to look for both of these important information and to figure out how to interpret the data as well. So first, I want to answer the question, why days of supply and turns? So most commonly, we use dollars when we're trying to measure how much inventory we have. It's kind of the most standard way to measure inventory, but this leaves us with a big hole in our data. It doesn't answer all of the questions we need to know sometimes about our inventory and how much we have. And sometimes it's important to note how small or large our inventory is. When we use dollars, we don't get these answers from the number that we get. However, days of supply and turns can help answer those questions. So when someone wants to know how big or large, small or large our inventory is, you would turn to days of supply and turns to find these answers. So the days of supply formula, like we learned earlier, Little's law can be applied to many different things, but I'm just going to go over it first again. So Little's law can be interpreted as inventory equals the flow rate times the flow time. We've mentioned this before in class, but this is really important and can be applied to a lot of different things. It's important to note that the days of supply is equal to T, and T being the flow time. And it's also important to note that the average inventory divided by the cost of goods sold times 365 days can also be used in this situation. Like I mentioned before, days of supply can provide us a lot of answers, but it can't always be applied to every situation. We can use different increments of time, such as weeks, hours, months, etc. Sometimes days won't give us the answers we need, but if we use different intervals, we can find the answer faster, or it gives us more of a better idea of, the inventory, how small or large it is. And it's actually pretty easy to calculate this. We're able to calculate this by easily converting the days of supply into the desired time. So for example, if we have 54 days of supply, but we wish to know the weeks of supply. This can be easily calculated by taking the days of supply, which would be 54, divided by 7 days a week, 7. And this would be about 7.71 weeks of supply. So it's just important to also know not only how to calculate days of supply, but also how to convert it easily. So you can apply it to different situations that might need larger increments of time or smaller increments of time, just depending on the situation. I'll give you a second to write this down. Okay, so next I will be discussing inventory turns. Inventory turns are the number of times the average inventory flows through a process in an interval of time. It is important to know how to calculate this, but it is almost just as important to understand how to interpret the data that it produces. So it's important to note, make sure you get this down in your notes, that a higher turn means less inventory. This is important, so once you do all your calculations, you can know how to apply it to what you're talking about, which would be inventory. So you're trying to answer the question, is it small or large? And so it's important that you know a higher turn means less inventory. Turns can be calculated by R divided by I. And it's also important to note that R divided by I is also equal to 1 over T, which equals 1 over days of supply. So these all kind of link together. And it's important to understand Little's law and also understand days of supply as well as inventory turns. Now I'm going to just share a brief video with you guys, just further explaining inventory turnover.
Inventory turnover is a popular inventory management concept, which is used to determine the overall efficiency of an entire supply chain. The ratio reflects the number of times inventory is replaced during a given period of time and can give a useful indication of trends and how well a company controls its merchandise. So what does this magic formula look like? Well, numerically, inventory turnover is calculated as the ratio between the cost of goods sold divided by the cost price of the average stock level over the same time period. Typically, retail companies want this ratio to be as high as possible. This indicates that they don't overspend by buying too much inventory or waste resources on items that they don't sell, and that the inventory they do buy can be sold effectively. The result can also provide valuable insight from a supply chain management perspective. SKUs associated with low inventory turnover ratios, companies holding excessive or even dead inventory, and as such, this can help in identifying those items which should be written off. The key aim of a company is to rotate inventory as many times as possible to maximize their profits. This introduces a multiplier effect, which highlights a company's capacity to generate profit on capital. The best way to illustrate this is with an example. So, if I have one biscuit here, which I can get from my cheap supplier for the fairly reasonable price of $1, this I then go and sell for perhaps the princely sum of $2, maybe in one of those posh organic food stores. Then with these $2, I go and buy 2 more biscuits, which I, of course, can then sell for $4. So here what I'm doing is I'm making money by turning dollars into stock and then that stock back into money. And this process repeats itself again and again with more money to reinvest each time. This is what we call the multiplier effect. Basically, the more turns I can get out of this process to find how good I am at playing this game, and in reality, how profitable I'm going to be. So it all sounds great on the surface, but where are the limitations? Well, in reality, businesses want to look at the margin they are making with a product. So if we imagine that in that biscuit example, we also sold one of those expensive healthy muesli bars for a profit of $10 in the time that we sold our 4 biscuits, then inventory turns become somewhat negligible. As such, inventory turnover only takes an average viewpoint and does not reflect the fluctuations of inventory and activity during a year, such as those seasonal sales peaks we discussed in a previous episode. It also ignores things like supplier constraints, batch sizes, MOQs, lead times, which in practice are usually the driving force behind the observed inventory turnover ratios. So for those overseas suppliers, it makes sense to hold higher stock levels, as the stock needed to cover the whole lead time demand is much higher. And so to conclude, taking a lower turns perspective is narrow. As such, whilst turns may provide a high-level insight about the supply chain as a whole, refining these measurements so they're done in the right way requires a hell of a lot of effort, and this can only be achieved through bespoke implementations. So that's everything for this week. If you've got any questions, make sure you leave us a comment below, and we'll see you next time. Bye for now.
Okay, so I hope this video helped further explain turns, and you were able to take some notes on it, because it is really important to understand. Next, I'm going to go over a couple practice problems just so you get familiarized with how to use these equations and apply them to scenarios. So this first problem is Nike Shoes currently has 3,500,000 shoes in its inventory. It sells 12,000 shoes per day. What would be Nike's days of supply of their shoes? So I'll just give you a couple seconds to write this down and try calculating it on your own, and then I will go over the solution in a couple of seconds. Okay, so I hope you guys have been able to try this practice problem on your own, and now I'm going to go over the answer. So the answer would be the days of supply, which equals T, which equals I over R. This would be 3,500,000 shoes divided by 12,000 shoes per day. And when we do this, we get about 292 or 291.66 shoes. So this is really important to understand how to use days of supply so we can apply it to problems like this, which are, real life situations. And this might be a time when you would need to calculate days of supply. So understanding how to apply this to a scenario is really important. Next, I'm going to go on to the next practice problem. The next practice problem is Ding Tea sells boba at a shop. Its annual sales are $10 million, and it has an average of $25,000 in inventory. What are its annual inventory turns? So again, I will give you a couple of seconds just to try this problem on your own, and then I'll go over the answers. Alrighty. So the answer, annual turns, like I mentioned before, is 1 over T or R over I. So the answer would be 10 million divided by 25,000, which would be 400 turns. I hope this helped you guys implement what I talked about earlier, and you were able to get the answers. Both of these terms are really important and can be really useful for calculating lots of things and understanding inventory better. But yeah, thank you for listening. Okay.
Hi everybody, my name is Inez, and I'm going to be teaching you guys about section 10.3, which is about evaluating inventory turns and also days of supply by looking at financial reports. So the overall goal for this section is to be able to determine inventory turns, days of supply, and also months of supply by looking at financial reports. So I'll first go over the key terms for this. So the first one is inventory turns, which is the number of times the average inventory flows through a process in a certain interval of time. So that could be days, months, whatever. Days of supply is the average amount of time in days calculated that it takes for a unit to flow through a system. To give more clarity, I'm going to be showing you guys this video. It talks more about inventory turns and how to solve them.
What is the definition of inventory turns and how do I calculate it? Inventory turnover is an indicator of speed or velocity in a company. How quickly does a company turn its inventory into sales? How many times is the inventory sold or used in a year? Inventory turns can be a very meaningful metric for a retail company or an industrial company. Different companies and different people use different definitions of inventory turnover. Rather than asking what is the right definition, I would like to ask what is the most useful definition. A. Inventory turns as the ratio between sales and inventory. Or B. Inventory turns as the ratio between cost of goods sold and inventory. When you drill down into the components, you will see that the first definition has units sold times the selling price per unit in the numerator and units in stock times cost per unit in the denominator. The second definition has units sold times cost per unit in the numerator and units in stock times cost per unit in the denominator. As cost per unit divided by cost per unit equals 1, you are in the second definition basically just dividing units sold by units in stock, and those are the only two variables that can be influenced when you strive for improvement. In my opinion, option A, inventory turns as the ratio between sales and inventory, is the most useful definition. As a finance director in a company, you can help create value for this company by providing visibility of the drivers of this key ratio of inventory turns. The management team can then ask the right questions to drive results. How do we sell more units? How do we increase the price per unit sold? How do we optimize our supply chain so we have fewer units in stock? How do we work on productivity to lower the cost per unit? The second reason I prefer option A is that it links closely to asset turnover, sales over assets, in the DuPont formula, a key business equation that every business and finance person should understand. If you prefer option B, then there are several videos available on other YouTube channels that take you through a calculation. How do I calculate inventory turns for a company? Let's take retailer Walmart as an example. In their annual report, you can find net sales in the income statement and the inventory balance on the asset side of the balance sheet. Inventory turns equals sales over inventory. We take the 12 months sales of 481.3 billion and divide it by the average inventory of 43.8 billion. You could even make this more sophisticated by looking up Walmart's quarterly reports and making the average inventory a 5-point average rather than a 2-point average. Walmart in fiscal year 2017 had inventory turns of 11. For some people, inventory turnover is a bit abstract and stock days is a more tangible metric. Stock days or inventory days are calculated by taking the 365 days in a year and dividing them by the number of inventory turns. In this example of Walmart, the stock days are 33. Thank you for watching. If you enjoyed this example of how to calculate inventory turnover, then please press the like button for me and share it with friends and colleagues. On this end screen, there are a few suggestions of videos you can watch next. Please subscribe to the Finance Storyteller YouTube channel. Thank you.
Okay, so I hope that video gave you guys a little more clarity about inventory turns. So you also might be asking yourself, how can we determine an inventory's turns? Like, how can we get the financial statements? So it actually depends on the type of company that you want to determine. So publicly traded businesses, they're legally required to share their financial statements. But private companies, they don't share their financial statements to the public. So you're not able to access all their spendings and earnings. So a way that you could find a public business's financial reports is by looking at the Securities and Exchange Commission's filings, which you can find online, and that will tell you all the information that you will need. So I'll go over an example for you guys. We'll look at Whole Foods. So Whole Foods uses $1 as their flow unit because they sell so many different products. But in order to find the inventory turn, we're going to use Little's Law, which the formula is I equals R times T. So in this example, we're going to look at their 2012 balance sheet. So if you look under the assets, and the line that's labeled as merchandise inventories, you'll notice that they made $374 million. So we're going to use $374 million as their I, their inventory, and I equals R times T. And then if we also look in the financial statements, we'll notice that they made 11,693 million in revenue, which we're going to use for the R in I equals R times T. So we'll also notice that the cost of goods sold was about 7,543 million, which translates to 7.5 billion purchased from their suppliers. So that will be used as cost dollars. And then they sold those goods for about 11.7 billion. So that would be determined as their sales dollars, profit. Okay, so we're going to use those two estimated flow units, but we have to decide which flow unit to use. And it's also very important to notice that to choose which flow unit to use, all activities must be described in the same flow unit. So we notice that inventory is reported in cost dollars. So the total inventory is the total amount spent to buy goods, not the total amount at which Whole Foods sells the inventory to customers. So if the inventory is reported in cost dollars, we have to choose also cost dollars for the flow rate. So R equals 7,543 million, and we'll divide it by 365 days. That's going to give us 20.7 million. So what does that really mean? It means that Whole Foods sells customers goods that they purchase for 20.7 million each day, and that's based on average. Continuing that example, we're going to use Little's Law again. So we're going to take 374 million, and then we're going to, as our inventory, our revenue is going to be 20.7 million per day, and then we're going to times it by T. To find T, we have to do 374 million divided by 20.7 million per day, and that's going to give us 18.1 days. So what does that 18.1 days mean? It means that it took 18.1 days to estimate for the time an average cost dollar spends during the Whole Foods process. So inventory would last 18.1 days if they did not replenish any of its inventory and if demand continued to stay at the same rate. So what it also tells us is how efficient Whole Foods is with their inventory management and how fast they can get things through the process. So then we're also going to solve the annual turns for Whole Foods. So the formula for turns is R divided by I. So we're going to take 7,543 million divided by 374 million, and that's going to give us 20.17 per year. And I hope that one made more sense, but if you're still having trouble, I'll go over another example to check your understanding. So this question asks, Widner Industries reports annual sales of $160 million. Cost of goods sold is $120 million, inventory of $20 million, and net income of $5 million. So we're going to have to find its annual inventory turns. So to find that, we're going to first find the flow rate, which is R. So that's going to be 120 million per year. We're going to find our inventory, which is stated in the question, is 20 million. So we're going to do our turns formula again. So that's going to be R divided by I. So 120 million divided by 20 million, that's going to give us 6 turns per year. So now with this example, it's asking for months of supply instead of days of supply. So first, we're going to find our flow rate, which is R, 120 million per year. And we're going to divide that 120 million into the 12 months in the year. So 12 divided by 120 million, that's going to give us 10 million per month. So we're going to find months of supply by doing I divided by R, which is 20 million divided by 10 million, and that's going to give us 2 months of supply. So I hope these examples give you a better understanding of how to find months of supply, days of supply, and inventory turns. And thank you for listening.
Hello class, my name is Justin Smith and I'll be going over section 4 of chapter 10 titled Inventory Stockout and Holding Costs. In the previous sections discussed, my group mates discussed the reasons for inventory and explained how to measure it. And now we need to become a little bit more precise in regards to the various costs associated with either not having inventory or holding on to it. So if a customer wants a product and it's not available, then this situation is referred to as a stockout. Simply put, a stockout is costly to a firm because it irritates their customers. But not all stockouts lead to equally irritated customers, which means that the cost of not having inventory can vary considerably. To explain, the table provided below divides the possible reactions of a customer of a stockout into 4 buckets that differ in the severity of the consequences of the stockout. You might assume that if a retailer doesn't have a product, then the worst thing that could happen is that the customer leaves the store without buying the item, thereby denying the retailer the opportunity to make some profit on the sale. This is the second response listed in the table provided below, and it is indeed costly to the retailer, but it's not as bad as it could be. As described in the first response listed below, not only might the retailer lose the opportunity to make this sale, the customer may be sufficiently irate that he or she switches their future business to a competitor, and that'll definitely be costly. But it's not as bad as it may seem, as shown in the third response, where the retailer loses the sale of the first item but gains the sale of a similar item that the customer is willing to substitute. If the other item is equally profitable, then this might not be costly to the firm at all. In fact, if the customer switches to a more profitable item, then the firm might even gain in the short term. There is even a tactic to exploit this, which is known as bait and switch. Auto dealers are known for trying to bait and switch their customers. They advertise a car that is offered with a great deal, but somehow they never have the car in stock when you arrive to buy it. Instead, they have a similar car that has more features and, big surprise, a higher price. With this tactic may work in short term, but is dangerous to implement in the long term because customers may catch on to your shysty ways and take their business elsewhere. In the last response provided below in the table, this causes the least pain to the firm. Sometimes customers are willing to wait for a product to arrive. This is likely to be the cause when a product is specialized or customized to the customer's needs or desires. For example, new business jets are rarely, or if ever, purchased as is from inventory. There is a considerable amount of customization with this product, so the buyers are patient enough to wait to get exactly what they want rather than buying what's already there. A similar situation occurs with customization of homes. Some people purchase homes as is from inventory, but others wait to have their dream homes built out. On a less expensive scale, customers are sometimes willing to wait for custom sofas or for specialized electronics, such as personalized gaming electronics, etc. A firm needs to know where it is on the stock cost spectrum described in the table. If stockouts are very costly, the firm risks losing their customers. Then the firm needs to make sure it has inventory available most of the time, if not nearly all of the time. On the other hand, if customers are willing to wait for the firm's product, then carrying inventory is clearly less important. And for the next section in chapter 10, we have section 4.2 titled Inventory Holding Costs. And just as there are different reasons why it is costly not to have inventory, there are different reasons why it is costly to hold on to inventory, and all of them are linked to the amount of time flow unit spends in inventory. Some key definitions we need to take note on are opportunity cost of capital, which can be defined as the income not earned on the amount invested in inventory. Next, we have inventory storage costs, which are the costs incurred to properly store, maintain, and insure your inventory. Next, we have obsolescence cost, which is the cost associated with losing value over time because of either technological change or shifts in fashion. And last, we have spoilage and shrinking costs, which are costs associated with theft or product deterioration over time. And the combination of these various costs defines the cost to hold inventory. While each component is usually relevant, at least to some degree, with all products vary as to which of these components is the greatest concern. For example, the opportunity cost of capital is the dominant component for a product that has little risk of technological obsolescence, doesn't deteriorate, is easy to store, and is hard to steal. Whereas a new product that uses the latest technology might face primarily obsolescence risks because even the latest technology can quickly become old technology. And now for the video that provides a little bit more detail into inventory holding costs and the components that are consisted.
In this video, we are going to discuss what are the components of inventory holding cost, why inventories are important, and how can we manage inventories under different conditions. Although businesses do not want to keep inventories, they have to keep inventories for a couple of reasons. One, uncertainty in the customer demand. We don't know exactly how many products we are going to sell. That means we have to keep enough inventory to satisfy that uncertain demand. The second one is the uncertainty in the supply side. These uncertainties could be associated with the quality, the quantity of the products we are going to get, the cost, and delivery times. And finally, we keep inventories because shipping larger quantities is cheaper. The Council of Supply Chain Management Professionals, CSCMP, publishes this yearly report called the State of the Logistics Report. Their 2017 report shows that in 2015, US businesses spent $427 billion as inventory holding cost, right? And that basically corresponds to $2,500 billion worth of inventories kept by the industry. Inventory holding cost has 4 components. Let's look into them one by one. Cost of capital is the largest one, and it is estimated to be between 20 and 40%. And I know many of you are probably thinking that that's very high into context of your business. For example, you might be working for a branch and you might be charged by 2 to 5% for your inventory per year from the headquarters for having those inventories. But when we talk about the cost of capital, we are basically thinking about the opportunity cost as well. So if you hadn't invested in inventory, but invested in stock market or opening a new branch, what would be your expected return on investment? And basically that gives you the cost of capital. The second one is the storage cost, and that is estimated to be between 15 and 18% in the US. Obsolescence cost, that's 5 to 7%, and insurance and taxes 1 to 2%. When you add up those numbers, it brings your overall bit somewhere between 40 and 65%. Again, I think some of you may be disagreeing with the 40 to 65% inventory holding rate, because that means you need to be very careful about the inventories because they are expensive. Now, for many businesses, selling this idea of 40 to 65% is really difficult. So what I think is that even if you are using the cost of capital at a lower rate, your probably realistic inventory holding rate or cost is going to be somewhere between 20 to 25%. So if you're really using less than 20%, I ask you to reconsider the numbers, look into your cost of capital and the opportunity cost one more time before making the final decision.
For the next section in Chapter 10, we have 4.3, inventory holding cost percentage. It can be a burden to add up the various factors that contribute to inventory holding costs. As a result, most companies use a shortcut. They usually assume a holding cost percentage, which is the ratio of the cost to hold an item in inventory during a designated time period relative to the cost to purchase the item. For example, an appliance retailer may assign an annual holding cost to a refrigerator equal to 20% of the cost to buy the refrigerator. This means that a refrigerator that costs $350 incurs for the retailer at a holding cost of 0.20 times $350 equaling $70 a year. If the retailer holds the refrigerator for 1 year, then the retailer incurs the cost of $70. Although it is common to define an annual holding cost percentage, it can be defined for any time period. For example, the retailer may assign a 0.5% weekly holding cost for a dishwasher that costs the retailer $200. In that case, the dishwasher could cost 0.005 times $200 equaling $1 per week to hold an inventory, and $52 per year to hold an inventory, assuming that the year has 52. And for the last section in chapter 10, we have 4.4, which is inventory holding cost per unit. The annual holding cost percentage tells us how much it costs to hold an item in inventory for 1 year, but most items aren't held for exactly 1 year in inventory. The actual amount of time is given to us by turns or days of supply. Hence, we can combine these pieces of information to evaluate the holding costs incurred by each unit in our inventory. Say Whole Foods' annual holding cost percentage is 30%. It is a growing company but doesn't face technological obsolescence or issues with changing fashion. For Whole Foods, how much inventory cost does it incur for a box of organic cereal that it buys from a supplier for $5? As we see that the box of cereal spends an average of 18 days in Whole Foods, which is 18 days divided by 365 days per year, equaling 0.049 years. To hold the $5 box for 1 year will cost Whole Foods about 0.3 times $5 equaling $1.50, but to hold it for the 0.049 years costs 0.049 times $5 equaling 0.245 cents. As Whole Foods might sell the box for $8, it makes a profit on the sale. The total cost is $5 plus 0.24 cents, equaling about $5.24, but sales revenue is $8. In addition to evaluating the inventory cost for a single item, we can eventually evaluate Whole Foods' entire annual inventory costs. If Whole Foods holds on average $374 million in inventory throughout the year, then each cost it incurs is 0.3 times 370 million, equaling $112 million in inventory costs. Though $112 million is a lot of money to most people, is it a lot to Whole Foods? Another way to express this is the percentage of the total cost of buying goods. Whole Foods' cost of goods sold, the amount it paid to buy all the stuff it sold during the year, is $7,543 million. So the inventory cost is $112 million divided by 7,543 million, equaling 1.5%. In fact, there's an easier way to get that number, which is the equation provided below, which is the inventory holding cost as percentage of COGS equaling annual holding cost percentage divided by annual turns. That will get you 30% divided by 20.17, which will get you 1.5%. And for most retailers, their final profit is generally anywhere from 2 to 5% of their cost of goods sold. Hence, good inventory control is critical for retailers to return a profit.
Hi, I'm Eric Tran, and I will be wrapping up the rest of Chapter 10. I'll be covering the main topics that you will need to know for the rest of the test, so if there's anything that you may want to pay attention to, it'll be these next few slides. Starting it off, why does inventory matter? Well, inventory is found at every single stage of processes, and this means that the raw material, the in-progress goods, and the finished end products all categorized as inventory. Also, keeping track of inventory is vital in all organizations. You need to keep track of what products need to be transported where, how many you have, how many you are sending off, and how much will be left after everything is done. When moving products, it requires flow time, and Little's law states that wherever there is flow time, there will be inventory. Next, we have two types of variability. First is predictable variability, otherwise known as seasonality, and it is the accumulation of inventory in advance of a high-demand season. A good example of this would be the upcoming Black Friday or Christmas holiday. There is usually a large influx of customers looking to purchase goods, and in order to satisfy the large quantity of customers, organizations are going to need to stock up a larger amount of inventory than they usually would carry during normal hours and times. The second type of variability is unpredictable or stochastic variability, where organizations need to build in buffer or safety stocks. Both terms mean exactly the same things and are usually used interchangeably with one another. Stochastic variability is less prevalent than seasonality, but it is used in smaller cases such as an influx between times during days rather than larger influxes like in the big holidays such as Christmas stated before. Next topic is going to be the importance of inventory. Without holding the right amount of inventory, it can cause a huge blow to a company's finances. If a company holds too little inventory, it can lead to a loss of a customer due to a competitor if the facility does not hold the product the customer is looking for at the given time. It's very easy for customers to just head over to a different store and purchase from a place that has stock readily available. And that's usually the reason why Amazon is so popular right now. You can look pretty much anything up on there and they'll probably have it. Although having too much inventory is also not good. The longer it holds a piece of inventory within their possession, they are going to end up having to pay the longer it stays. An example of this would be the cost of an item that is $50 and the holding cost is 30% per year. The cost of holding that item will be $15. We just multiply $50 by 30% and we have our number. Here is a good video that explains the importance of inventory and various ways an organization can categorize inventory.
Inventory management is a system whereby stock and assets are tracked as they enter and leave a destination, whether it be a warehouse, wholesaler, or final point of sale. Stock review is the easiest method to perform, and it is most appropriate for small businesses. The advantage is its simplicity. The disadvantages are that it's a time-consuming process and it's highly dependent on the skill and know-how of the person conducting the inventory review. The ABC system categorizes goods based on their value to quantity ratio. If you sell fewer higher value goods, you'll want to keep a smaller quantity of goods in stock. And if you sell more lower value items, you'll need to keep more of those goods in stock. Therefore, you classify your products into levels of value, quantity, so that you can maximize the value of your overall inventory. Hiring an inventory management firm allows your business to concentrate on its core function instead of spending excessive time maintaining optimal knowledge about the inventory control system being used. Your company can relax knowing that an inventory management expert is continually assuring and reassuring your needs and managing your goods accordingly. An expert management system taking advantage of the most efficient software can free up extra cash flow, which can get pretty tight sometimes for smaller or growing companies. If you question the efficiency of your inventory management, consider having an expert consultation to evaluate. Check out the Network Control blog for more helpful tips at network-control.com/blog.
Alright, I hope that gave a little bit of insight on how inventory can be handled. Moving on to the next topic, I'm going to be covering the key takeaways, if anything, that you should have gotten from this chapter. And this will most likely be the stuff that's going to be on our upcoming test. So starting with section 10.1, you should know the 3 different types of inventory, being raw material, work in process inventory, and finished goods. Next, we have the challenges time, forecasting, data tracking skills, product handling, and transportation assets. And the most important portion of section 10.1 is the very reason why inventory is needed in the first place. We have flow time, seasonality, batching, buffers, uncertain demand, and pricing that all will play a huge part in how you handle inventory. And next, we have 10.2, and you should know the definitions and formulas of the days of supply and inventory terms. Days of supply is going to be the flow time multiplied by the inventory all divided by the annual cost of goods sold. Inventory turns are going to be the flow rate divided by inventory, and annual turns are going to be the annual cost of goods sold divided by the inventory. In 10.3, it was mostly focused on applying the formulas and definitions that we were given and applying them to different scenarios. In 10.4, I think the main thing to take away is that the inventory holding cost as a percentage of cost of goods sold is the annual holding cost percentage divided by the annual turns. Alright, now that we've covered every single section, it's time to do a few problems to check for understanding. So a retailer has $500,000 in inventory and sells $15,000 per day. What is its day of supply? Okay, well, looking back at the days of supply formula, it was inventory divided by flow rate. So we were already given that the retailer currently has $500,000 in inventory and the flow rate is given $15,000 per day. And just like that, we have the components that are needed in order to plug into our formula. So we would simply just divide $500,000 by $15,000 and we would get about 33 days for our answer. Nice and simple. Move on to the next one. A wholesaler reports that a distribution center turns its inventory 5.6 times per year. What is its month of supply? Looking at what the question is asking, it's asking for the month of supply this time rather than the day of supply. So let's break it down a little bit. We're given the annual turns of 5.6 times per year. And if we recall, the inventory turnover formula is 1 divided by the annual turn. So dividing 1 by 5.6 will give us an inventory turn of 0.179. Since the question is asking us for the months of supply, we need the amount of months within a year, which we all know is going to be 12. And we multiply that by our inventory turnover, and we come out with our answer of 2.15 months. Alright, our next question is going to be providing us with a table, and it is asking us for the supermarket's inventory return. Again, let's start off with the formula that we need to use for this. We see the keyword inventory returns, so already we know we are going to use the inventory turns formula, which is, as we used before, the flow rate divided by inventory. Looking at the table, we see that inventory is given to us with the value of 6,244, and our flow rate is the cost of goods sold, which is going to be 76,858. And now it's just a simple case of plugging our numbers into the formula again. We take 76,858 divided by 6,244, and we get an inventory return of 12.3 per year. Alright, last problem we're going to take over, and it's going to say the holding cost of inventory at a retailer is 35% per year. The retailer's annual turn are 3, and how much does it take, or how much does it cost rather, the retailer to hold a dress that it purchased for $50. Just like the past problems, I like to take the question piece by piece, starting with what the question is asking. It's asking how much cost for the retailer to hold the dress. So first, we need to see how much it would cost the retailer to hold the dress for 1 year. We take the yearly holding cost of 35% and multiply that by the value of the dress, which is $50. And that comes out with our total of $17.50 to hold the dress for 1 whole year. Next, we have to find out the years of supply, and the formula for that is going to be 1 divided by the annual turns. And we are given that the annual turns is 3, so we are going to be dividing 1 over 3. After that, we are just going to be multiplying the cost of the dress, which we computed earlier, which is $17.50, by the years of supply, 1 over 3, and we got our answer of $5.93. Essentially, for these problems, my best piece of advice that I can give everybody is to dissect the problems into as many parts as possible, starting with what the question is asking, and from there you can figure out what formula to use. And the more pieces you have, the more pieces you'll have to insert into your formulas. And when you do it like that, it'll just become exponentially easier for you to solve any problem that's given to you. And with that last piece of advice, that'll bring the end of our presentation. Thanks for watching, everybody, and have a nice day.